So here's an interesting question. Can I use life insurance to help prepare for retirement? Now, before you jump to the automatic conclusion that makes absolutely no sense, believe it or not, there are a lot of people that are using life insurance to supplement the income that they're trying to create as they work toward their retirement. And it's important before we show you how a person can use life insurance to prepare for retirement, we really need to understand why. Why would a person in their right mind even contemplate using life insurance to add to their retirement income? Well, it really comes down to one simple question. I'm going to try to draw some arrows here. Forgive my horrible drawing, but it really comes down to this. Do you believe that taxes are going to go up or down? That's the question. Now, I know that's contrary to what many of us might do. Typically, when we start planning for retirement, we just pick out the retirement account that's available to us at our job and we put it on autopilot and we don't think about it. But this is an important question. And if you believe taxes are going to go up, then it absolutely matters where you save your money, right? So if I'm a person who believes that taxes are going to go up, I don't want to deal with the headache of having to navigate how much taxes I'll pay in retirement, because that is my choice, of course. I can choose whether I want to deal with that or not. So if I've decided that I don't want to deal with taxes in retirement and I want to avoid the risk that taxes will go up, then I need to look for options that are tax-free. So if we kind of take that route and we say, well, what are the tax-free options? Then we kind of look at something like this, right? See if we can get this on the screen, right? Well, we have on the screen here just three options, right? These are typically the places we go to try to save and grow our money. We can put it into taxable accounts, tax deferred accounts, or tax-free accounts. When you think about taxable accounts, what you're really talking about is money that's taxed every single year. If you've ever made money inside of your savings account and you've gotten that maybe 1%, 0.1% credited back to you, technically they'd send you a 1099 in the mail and you should pay taxes on the growth, right? But the point is that those accounts are taxed every single year. Tax deferred accounts are like 401ks, traditional retirement accounts that we put our money into. You pay taxes, not now, you pay it later. You basically forego paying taxes now with the promise that you'll pay taxes at a future date. Now, the risk associated with that is that if your money does what you want it to do, which is grow, you just deferred into a later date a larger tax burden. Here's a really simple example. I'm oversimplifying it, but here's a simple example. If I have $10,000 today and it grows to $100,000 tomorrow, when I defer my taxes, I'm saying I don't want to pay the taxes on the $10,000 today. I'd rather pay the taxes on the $100,000 tomorrow, right? And that's with the hope that maybe, I'll be in a lower tax bracket, but if tax rates go up, it may not even matter, right? Now, the third option, which is the option that a person may be trying to get to if they've decided they don't want to deal with taxes when they get to retirement, is this tax-free bucket. Now, in order for you to put significant money into a tax-free position, you're going to have to be a little unconventional. Here's what I mean. You could put money into a Roth IRA, but Roth IRAs have limits. If you make too much money, you can't fund them. And even if you don't make too much money, you can only put $6,000 a year into those accounts. What if you want to contribute more than that? Well, maybe if your job has a Roth 401k, you might be able to put money into that. But even if you do, the additional match that you get will go into a traditional type of 401k. And that may be fine. That may be okay with you. Not all companies offer a Roth 401k, and especially with 403bs, those who work for non-for-profits or government entities, they're even slower to offer 403bs that are Roth-like in nature, allowing you to pay taxes today and get the money tax-free tomorrow. Right? So that moves a person to look at some additional options. Maybe they look at a health savings account. If you follow the rules, you could get money out tax-free. Maybe a person might look at a reverse mortgage, thinking that they could use that to create retirement income in the future. And what we're talking about today is a person may look at life insurance, right? And they may try to use this after they used a couple of other things. So it may go like this. Maybe a person has put money into their 401k up to the match because that's free money. You don't want to give that away. Then a person may put money into their Roth IRA. They may max that out. And if a person still has additional money they want to save and they want to get competitive growth, but they still want it to be tax advantaged, they may look at life insurance. So how can a person actually design life insurance to create retirement income for themselves? Let's look at an example. I'm going to attempt to draw again. So hopefully you are able to follow my drawing. I'll try to keep it really simple. So in this example, just imagine, we have a box, right? And when we typically buy life insurance, what we're trying to do is we're trying to spend just enough money, right, to pay for the life insurance, right? That's all we want to pay for. So maybe we shop the market and maybe we find life insurance for $20, $50, or whatever the case may be, right? I don't know. And if a person is just looking for life insurance, that's fine. In fact, we help clients all the time. If they're just looking to get life insurance, we can certainly help them do that. But when a person is trying to design life insurance for retirement income, the goal is to put as little as possible toward the life insurance part and have the rest of the money go to the cash value, right? And once that money is in the cash value, it can grow based on how that money is allocated inside the insurance company. And there are a lot of different ways to do that. For example, a person can put it into an indexing strategy that will allow you to participate in the upside of the market without participating in the downside. So if the market gets 10, 11, 12, 13%, you can capture some of those double-digit gains, sometimes high single digits. But if the market goes low, -20, -30, your money does not go down because the market has underperformed, right? So that's just one way you can try to grow your money inside of these accounts. But the key is that if you're going to use it for retirement income, the majority of the money has to go to the cash value, small amount to the life insurance. And so, we're wrapping the smallest amount of life insurance around our cash, almost like a rubber band, right? Just the smallest rubber band possible needed to hold the cash together. Now, let's look at an example. We're going to look at a bad example and a good example, because what you're getting ready to see is what most people think of, right? So let's say a client has maxed out their Roth IRA, and let's say they've put money into their 401k up to the match, but they're looking for additional ways to save. Now, in this example, they're saving $12,000 a year to use as retirement income when they stop working. And if you follow down to 65, you can see that the cash value, let's see if we can get this right. Cash value is $294,000, right? Now, if you do the math, this person, they didn't even get out of this account what they put into it. They put in over 300 and something thousand, and they're walking away with 294,000. So they actually lost money. Now, when people tell you that life insurance is bad and that it's a horrible strategy to grow money, this is probably what they're thinking about. Now, I went out and I found probably the worst possible example that I could find. But the reason why this value of cash here is so low is because most of the money was going to pay for this death benefit. Now, let's flip this entire thing on its head. It's the same $12,000, right? What happens if we lower this death benefit to maybe 250,000, right? Well, more money is going to go to the cash value for growth, right? Let's look at an example of that. Right now, in this example, I blew up the part of it I wanted you to see. Obviously, I'm keeping all of the insurance companies confidential, just out of respect for them. You know, I don't want to put their business out here. But I did go ahead and keep the number so that we can just see this realistic example. So in this example, we're assuming that a person can just average 5.1%, right? So if they can get 5.1 in this account, then as they save that same $12,000, if you notice here, we'll zoom in here real quick. If you notice, the death benefit is smaller, right? It's smaller. That's on purpose because more of the money is going to the cash. Right now, when you get down here to 65, instead of just having that 250,000, you have 827,000 available to use to supplement your retirement. You see the difference? Because most of your money went to the cash value and it was able to grow, you can now use this money to provide retirement income. Now, I get it. There's so much more to using a strategy like this than what I just showed you. The whole purpose of this little presentation was just to show that it's possible. It is possible to flip life insurance on its head and use it to accumulate money that can be distributed later in retirement. There are probably other questions like what's a reasonable rate of return to expect? You know, I use 5.1, but what's reasonable, what's possible, right? How much does all of this cost, right? What's the cost structure of it? And how do you get income out of this account? Like, what is that like? How does that work? But we'll jump into that in future videos. Once again, the purpose of this video was just to show that using life insurance to create retirement income is very much possible. And really, there are some huge benefits to being able to grow your money in this way. For example, let me write this out. So for example, no stock market risk. So if you have some money allocated toward the stock market, this gives you a safe place so that you can be diversified in how you grow your money. Also, you have access to cash, right? Including the actual death benefit. In the event that you get sick, you have to go into a nursing home or you become terminally ill. Even up here, all right, let's see if we can zoom in. Even up here in the very beginning, you know, you put in $12,000 and you get sick, you can access this death benefit to use to provide for your care in certain situations, right? You also have access to this cash the entire way through. So if emergencies or opportunities come up, you don't have to fight with the company to get access to your money. Even as early as the first year, you have access to cash that you can use as you see fit. So there are a lot of benefits that are associated with this. And, you know, we're going to publish more content to really demystify life insurance because it's a lot of negative attention, a lot of false things on both sides. Some people make it seem like it's the best thing since sliced bread. Others make it seem like it's the worst thing you could ever do in your entire life. But neither one of those are true. So hopefully this helped. If you have questions, if you enjoyed the comment, let me know. And we'll be talking again soon.